my ugly mug. All right, this is being recorded, everybody. And one thing I say at the beginning of every single webinar is watch this again. You don't have to watch this exact same webinar on the broken wing butterfly. You can watch one of the other ones that I've done, but watch it again relatively soon afterwards so that the nuances stick into your long-term memory, okay? If you just watch this once today and a month down the road you decide to put this out, you're going to have to like learn it all over again. So try and take care of that right away. Just get it out of the way and you'll remember it. Stone Mountain, Georgia is in the house. All right. Let me get a couple of things out of the way real quick. My name is Eric Wilkinson. You may recognize me from CNBC, Fox Business, or the Wall Street Journal. They nicknamed me the Wolfman. I actually started trading in college with some money I'd earned, and then after graduating from college with a finance degree, I moved up to Chicago. And in that time, I've traded everything from stocks, financial futures, commodities, currencies, and options, basically on all these products and just about every market condition. Yeah, basically we say this is for informational purposes. We're trying to teach you guys how to swim. We're not here to swim for you. So anything I talk about does not constitute investment advice, all right? And we may be even talking about some stocks or strategies that are already in my portfolio. I'm not trying to get you guys to limbing off the cliff with me. I'm just here to help you guys learn how to swim in this market here. And remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, you can follow me on Twitter at Wolfman's blog and our parent company at ProTraderStrat for any kind of market wisdom and other snark from me usually. All right, this is on the broken wing put butterfly. And one thing I want to emphasize is let's pretend we don't know about this yet, okay? We don't know we're doing a put butterfly because what we're doing is we're coming into a market and we have to come up with our assumption first, which is usually the steps we take and, before we put on any strategy, right? We say, all right, this market is going to go higher, and then you put on a bullish strategy. Well, in this case, we are looking for more of a neutral type situation, but we also aren't too worried about it if it starts traveling up. We want it to stay right where it is, but we aren't worried if the market continues higher. So despite the fact that we're talking about a put butterfly, it is neutral, but we can be a little bit bullish. You know, if you are worried about one side or the other, this would be, we are concerned about the upside. We want to eliminate any upside risk. By doing that, we are going to have to add a little downside risk in order to achieve that, but we'll get that taken care of. All right. Some people like to call it a skip strike butterfly or a wounded wing butterfly. You may have heard it in those kind of fashion. I like to call it the broken wing butterfly. That's what I was brought up learning it as, and that's the way I kind of remember it. All right. So if you guys have been following along with this whole course that we've been doing, we're coming up with a market bias. We are biased to the upside, but now we're starting to move into more market neutral strategies, okay? So it's neutral to bullish. And the reason why it's bullish is because the broken wing butterfly, it has a synthetic short put spread in there, all right? So that short put spread is bullish, right? So that's what's going to make it a little bit more bullish to the upside. Again, though, if we are eliminating risk to the upside, if we eliminate that, we're increasing our risk to the downside, all right, to eliminate this, all right? So we're trying to eliminate upside. So it's more neutral, like that's where the big bang for our buck is going to be, but it's still slightly bullish, and we've been doing the bullish strategy, so we're starting to roll into more market neutral type strategies, all right? So we have to have a market assumption. We've got that. We're saying we are neutral, more neutral, but we are worried about the upside, okay? Another thing we have to have is high implied volatility percent. I'll show you guys how to figure that out. If you guys don't know what that is, we'll go into that in a little bit more detail. And we always need to collect a credit or at least do it from zero. When we're adding, you guys heard me talk about this, we're adding more risk on the downside. And if we are adding more risk to the downside, we need to be, compensated for that. And the compensation is by eliminating any upside. And with a credit, we will do that. Or zero, we basically eliminate the upside. I like to get a little bit of a credit, but sometimes it will be for a, sorry, I don't know why I went backwards. It will be for a more of a bullish move. All right, so this is what I was talking about. We're going to be selling an at the money or just slightly in the money put. I'm probably going to lean towards the in the money put right now, and then sell 2 out of the money puts, and then we're going to skip a strike. Now, this is where the skip strike is, where that whole, the whole synthetic short strike is. So if we were going to say XYZ is, let's just say it's trading at around $100, okay? This is XYZ is trading around $100. So we're going to be looking at the puts. Let's just say we do the 100. A normal butterfly would be the 100. Let's say the 95, 90, okay? So we're buying this, selling 2 of those, and then we're buying this one. Well, when we are going to sell this synthetic strike, we're actually kind of selling the 90 puts and then buying the 85 puts, all right? So this is that put spread I'm talking about. That's your synthetic short put spread. So that eliminates this one. So then we have the 100, the 95, 85. Okay, so that's what we're skipping, that 90 strike by selling a 90 strike and then buying the 85 strike. Okay, and I'll beat that one into the ground by the end of it. You'll have complete understanding, hopefully, by that end of this. All right, so our keys to success is picking the right underlying. First thing we know, we come up with XYZ, and we say we're kind of thinking it's going to be neutral to bullish. All right, so that's what we've come up with as our assumption right away. Now we need to figure out if XYZ is an appropriate underlying to trade options. Oh, that's what I keep doing. I keep hitting the roller on my my thing. Sorry. I keep hitting the roller on my mouse. So one thing we can do is pull up the option montage, which this is an option montage. It's on this page, the trade page. It's got all of the strikes for all the different months and stuff like that. We want to go to the spot month, and usually the spot month right now is going to be the about 43 days to expiration here. So let me pull this one up. I'm trying to use the wrong one. So 43 days to expiration is usually the spot month right here. It's somewhere right around the close. You basically want to go as close to 35 days to expiration. That's usually when all the eyeballs are on that particular option montage, okay? So right now we're going to be looking at these because it's as close to 35 days as we can get. And what we want to do is look at XYZ or Nike in this example, and any stock that's under $100. So if it's less than $100, we want to make sure that the bid to the offer is less than 10 cents, equal to or less than 10 cents. All right. So then we come down here and we can see that Nike fits that rule. These are all within, and we want to look at the ones that are just slightly out of the money. You can see that all those fit that rule. Now, if we're looking at a stock that's over $100, let's just check out Lulu here. Now we go and move the decimal 3 ticks to the left. So just move it 1, 2, 3, and basically we come up with 17 cents. So now we drop down to here to the option montage and look at these and make sure that the options are within 15 cents or 17 cents during open market operations. Now, after the close, we all know when the market closes, if you have a day trade, just a day trade in there, trade good for the day, that gets canceled as soon as the market closes. And we obviously are after the close. I'm on West Coast time, so after 4 o'clock East Coast time. So we can see that It's after the market. So we need to double check this during the open market operations to make sure that Lululemon fits that rule for the right underlying. Excuse me. Most of the time, anything that's over here, my option watch list, is going to be good to go for fitting that rule. After the close, it's a toss-up to find it necessarily. And then we also want to pick the right environment. So when we're doing this, we want to have high implied volatility. Now, you guys, if you've watched any of my other webinars, you guys know that when I was talking about this, I'll just use this pen. We talk about the standard deviation curve. So we have a standard deviation curve that can look like this, one that looks like this, and one that looks really flat. So we kind of do it like that, right? And this is a normal curve where you got your standard deviations. This one's where there's really low implied volatility, and this one has high implied volatility, okay? So the standard deviations are further away, and that's what we want with this strategy. We want to be able to get our wings further apart. That allows us more room for error. It also gives us more wiggle room to make some money when the market is a little bit more volatile than normal, all right? So once that starts settling down, then we see the volatility come back out, and you know, hopefully our strike locations are far enough away that when this volatility comes out, we will be able to make our money much quicker. I'll show you that on the platform when we pull up that as well. I'll show you how you can see how high we want high volatility on this. And as a matter of fact, if you have low volatility like this curve right here, it's going to be difficult to set this strategy up for that credit. Remember, I said one of the major things that we have to have with this strategy is at least do it for a credit or zero, all right? So you never want to do this strategy for a debit. And if it's in an environment like this, you're probably going to end up building the strategy out, and it's going to look like you're going to do a debit. Don't do it. Find another strategy that fits your directional assumption that is more appropriate for that environment you're seeing around that underlying. Okay. And then picking the right duration. We want a lot of theta decay happening in this because remember, we're selling two of the just slightly out of the money ones. We want those to decay quickly. So with theta decay, we'll see that happening. If volatility comes out at the same time, it'll even happen quicker. So we want to go towards that, you know, that magical number, 35 days to expiration. We're just slightly outside of that, which is fine. I like to actually set them up outside here anyway, because you have a lot more premium to play with. So that's what we're going to be looking at. Then we get this theta decay happening. That'll allow us to get out of this strategy rather quickly. And if you guys have played around with just butterflies before, you know butterflies take a little bit longer. You're going to have to hold them a little bit longer than some of my other strategies that we talk about. The butterfly just takes a little bit longer to decay. It has to do with the fact that we're, you know, playing with options that are very close to at the money, and those are going to have some gamma and other things in there. So it's going to be hard to get out of this strategy quickly, like we could with just a short call or a short put spread like we talked about last week. This one, you're going to have to hold on to it for a little bit longer for everything to work out correctly. But we want to get as close to 35 days to expiration so that we get this big drop in our premium. All right. This is where the money drop goes. And when you're collecting a credit, right, then that's the kind of opportunity you want. And then picking the right strikes. This is pretty key. The thing I want you to really take away from picking the right strikes is we are going to do this for a credit. All right. We want to get some kind of money or zero. Don't go any less than zero, because if you're a debit, we do not want to see that. All right. We want to wipe out the possibility of a debit straight away. And then finally, knowing our exit strategy. We need to know that we have to get out of this relatively quickly. So we're going to be looking to get out of this at about 50% of our max profit. And our max profit will come up here pretty soon, but that's what we're looking for. We want to get out at about 50% of max profit. And I'll go over max profit here in just a second, but that's what we're looking for in this strategy, 50% of max profit on it. And the reason why I don't want to go for the full thing is because it's really going to have to land very close to our 2 short strikes at expiration in order to get the full credit, and it's likely not going to happen for you. So get out at 50% of max profit, move on to the next strategy. All right, I want to go over a couple things real quick on the traditional butterfly versus the broken wing butterfly. With the traditional butterfly, you have to nail that number. And nailing the number, the 2 short strikes, the 2 short puts, that's where we need to land at in order to get our profit potential with the butterfly. Anything moving higher or lower is going to hurt us. With the broken wing butterfly, remember that short put spread, that synthetic short put spread transfers the risk from the upside. We have no more risk to the upside, but we add some risk to the downside, right? So we have a higher profit potential because if the market goes up, we can still get that credit we got at inception of the strategy. And we are going to have a higher max loss because we're adding more risk to the downside. So you don't want this market to move downward for you, all right? You want it only to go up. And by adding this higher max loss to the downside, we basically protect ourselves from any upside move, which is what we want with that, all right? So these are a couple of examples of the Analyze tab with the strategy here. So if we were to look at Philip Morris on this, and this is an older example, you can see this is the traditional butterfly. There's no skip strikes down here, all right? So we got the 85, the 82.5, which is basically right here. That's the one that is, where we would want the market to go to. And then we have these 80 puts. So you can see we can incur loss here to here. All of those, direction. That way we get a loss, that way we get a loss. But if I were to go in here and sell, if I sell an 80 put, sell the 80 puts and then buy the 77.5 puts, all right, synthetically into this. So if I pretend, go in and sell the 80 puts and buy the 77.5 puts, then all of a sudden you can see that our risk gets transferred from this upside to the downside. So before, where we had, the line coming out here, we have extended that to the downside, right? That's why we don't want that market to go down in this particular strategy, okay? So, because we've increased our risk there. You can let it go down a little bit, a couple of ticks. That's basically our room for error, but we don't care if it goes straight up here because we get to keep the credit. But if the market goes up and maybe comes back down, settles down here, then that would be the perfect case scenario for this strategy. All right, so let's get to the max profit and stuff. Profit target, like I said, 50% of max profit is going to be what we're looking to get out on this strategy. And our max profit is that higher strike minus the middle strike plus the credit, and times 100. I mean, everybody knows that, right? When we're talking 50 cents, it's really like $50, okay? But basically, we're taking the higher strike minus the middle strike, and then that is going to be our max profit on this. All right, max loss is that skip strike minus the lower strike. So in our example, back a little ways, let me see if I can slide this slider over so I can go back to that. Right here, this is the one I was looking for. So we're looking for our skip strike one. So this is where the skip strike is, right? That's ultimately the 80 strike. The 80 strike is where our skip strike is. So that's where we're going to start seeing the losses start coming in once we hit that skip strike there. All right. And then our break even is the skip strike plus the credit. So that 80, in this example here, our break even, was the 80 strike plus the credit, puts us just slightly below that, or minus that credit puts us just slightly below that on the puts. Okay. Now let's pull up the platform without further ado. I mean, everybody's probably bored with the slides already anyway, right? And this is a play on Vega and Theta. We want to exploit both of those. All right, so we want high implied volatility. Lulu, we've got it. There's earnings. One thing to note about this strategy, we don't want to implement this around earnings when they're just around the corner or, you know, several days in advance. I have specific rules for earnings, and Lulu does have an earning that is going to come in somewhere right probably around here. So I think they're going to have an earnings in there, and this is the month we're going to be looking at. So don't implement this strategy this far in advance of earnings, and I wouldn't even use the broken wing butterfly for earnings anyway. I have specific strategies that I like to use for those earnings trades anyway. But you can see that it has high implied volatility, so let's go with it. It's got one of the higher implied volatilities. Pretend we don't have the earnings in there. And it's trading right around 170, so I'm going to go slightly in the money for this one, at least to start it out. And like I said, we've got this as our traditional butterfly. Now, what I was saying is we go in and sell these 65 puts. So if I hold down the control button, hit sell, it gets rid of it. But that's the synthetic short spread in there that transfers some of that risk. All right, so we can pull this back down and go to analyze this trade and delete the old one that we had in there and delete this stock that's in there. That's a funky looking curve for some reason. But you can see anything to the upside, we get to keep this credit of $1.62. So we don't really mind if it goes way up. It's going to be hard for us to nail this number right here at 170. You know, that's, you know, throwing a bullseye blindfolded almost. So that's why it's great to build out this strategy this way, because we've eliminated our risk to the upside. Again, we don't want it to go down though, right? So that's why I was saying we're bullish to neutral. So we just don't really want it to make a big move down, right? We just want it to, we don't care if it makes a big move up. We just don't want it to make that big move down, right? We could look at IBM. I want to show you a couple of examples with IBM because we can compare this to something that has a similar price to it. So we're looking at IBM 130 strike. And so we got the 130 strike on this. I kind of lost my train of thought because of that. Sorry. Where was I going? $130. It's $132, right? So we build this strategy out like this, and we get a credit for it, all right? Now, what we can look at is implied volatility. We already know it has implied volatility percent of above 50, and the way we figure that out is we have to know where the current implied volatility is, which is 25, we can call it 26. The high is 40, and the low is 10. So let's just say we come up with our implied volatility percent. We take the current minus the low and take that sum and divide it by the high minus the low. All right. So in our example, we had 26 minus the low of 10. We take that sum and divide it by the high, which I think we said was 40 minus the 10. Right. So we've got 16 divided by 30. So that puts us slightly ahead, you know, at 51.5%. So basically the idea here is we want this as high implied volatility because it's a play on Vega. We want that volatility to come out. And you can see usually as volatility comes into these markets, they come out almost as quickly. So once it gets up at these elevated levels, then that's the opportunity to see this market volatility come out of the underlying. So we've seen a rapid rally up. You know, now we believe volatility is going to come out. I think that, say, IBM is going to stay in and around this area. But, you know, if you guys watch my daily market commentaries and know how I trade around the market profile, I would be worried that this market wants to go to the point of control. Right? That would be a reason why I want to eliminate any upside move, right? I'm not too concerned about this downside move. It looks like it's had its nice little correction. It came down, tested some the value areas, and now is starting to migrate higher. I believe, though, that it's going to stay right around here, and I'm worried about that move to the upside. So therefore, that's why I would build this out where I get a slight credit. The market rallies, I have nothing to worry about, right? If it nails the number right where I'm talking about, where we are right now, this 130 area, then I get to my max profit much quicker. And I'll be able to get out of this trade quicker, you know, at 50% of my max profit. We talked about the max profit on this, right? It's the width of those spreads, or the higher strike minus the lower strike there. All right. Then we can go over to check this out. So this is what I wanted to show you. We're looking at this right here. Now we know where the implied volatility percent. We know IBM, when it is trading has a Vega of 27, that's in the upper half of where it normally is. Now, all stocks aren't created equal. If I was looking at Tesla, this 27 might be very low for Tesla. It might be at 0 because Tesla spikes goes from basically, you know, 20 to 60 or something. So this would be a very low volatility for Tesla. IBM, we can see it's in the upper half. Now, if I go down and look at another stock that is similarly priced to IBM down here where it's got really low implied volatility, say, for instance, Disney. Where's Disney at? Let's just punch it in here. Let's look at Disney. And Disney, you can see, is 21. So it's trading around that same pricing. You know, we're going to have to go up an extra set of ticks here. But if we were to set it up where it's very similar in structure, then you can see I'm getting a credit for this. Oh, sorry. I want to buy this one, sell those two, and then buy that one. Sorry. It's low implied volatility. It's only down 6 percentage points from where IBM's pricing was. They're very similarly priced. You can see that now I have to do it for a debit. So this is one of those situations I would have to walk away from it. Why? Because it's got too low of an implied volatility. All right. You know, if it was up here in its upper half, we would be able to see that this strategy would work out as well. We can even look over here at Pepsi and see something similarly priced as well, being 132. It's probably even closer to the pricing that we saw in IBM. And we can go over here, see that it's got, you know, 10% percentage points lower on the implied volatility. Not the implied volatility percent, but the implied volatility. So if we go over here to the option montage and pick those same strikes that we did for the other one, buying this, selling 2 of those, and then skipping the strike and going out to the 20s, you can see I'm doing it for a debit again. All right. So that's why it's really important to do this when you have high implied volatility and in and around this underlying. Because remember what I was talking about with the bell curve. Let me just see if I can pull up a thing here. So when we were talking about bell curves, right? And we talk about, like, this is a normal standard deviation. We've got low volatility. It does that. And then, you know, high volatility, we kind of get a thing like that. Remember I talked about, like, this is a bucket of volatility. And if it's halfway filled up, you know, then it's a normal distribution. If it's almost empty and, you know, we got that bucket, there's almost nothing in it, well, it's going to jack up. But this one has a big old bucket on it of volatility that's almost full, so it's squished down. Same thing is going to happen with these. We looked at the Analyze tab. We got the Analyze tab kind of going like this on the Broken Wing Butterfly. Well, that would be with maybe, say, normal volatility. But if we get that volatility where it's filled this bucket up, well, our Analyze tab is going to look more like this, where it's stretched out a little bit more, okay? Because that volatility bucket is pushing down on this and squishing out the legs further. That's what we want, right? Because this, you know, is our risk then. We've got to we've been able to move our legs further away, kind of like in that example of Disney versus IBM, right? This would be the Disney example or the Pepsi example, and this is the example of IBM where it's just gotten further away. Does that make sense? For everybody, I see a question in here. On the IBM chart, could you use the Fibonaccis in place of the market profile? Absolutely. You know, I talk about this in a couple of other videos. Listen, don't let me or anyone else talk you out of something that's working for you. All right. If you have, I don't know, if I use, you know, the MACD, some people use, you know, the Ichimuchi cloud or whatever it's called. You know, whatever you're using, if it helps you see directional moves, then absolutely do it. You know, these are just the things that I found that work for me. And a lot of times when I'm setting up my Fibonaccis and stuff like that, I like to try and set up my Fibonaccis to somewhat line up with the other support and resistances I have for the market profile. So you can see that's another reason why I haven't probably switched this one in a while. Probably should get rid of that drawing, but absolutely. If you like market profile, you think it's going to go to a certain area, then for sure. I like the market profile just because I started out in college with a psychology degree and switched over to finance. And I believe that the market profile over here shows, shows the psychology of the market. So that's why I prefer to use it. All right. Does anybody else have any questions on that? So you can absolutely use whatever you want. Don't let anybody talk you out of it. If it's working for you, stick with it as far as I'm concerned. All right. What was the other thing I wanted to talk about? It's pretty close to it. This, oh, I know what I wanted to ask. This is where I throw it out to you guys. If you guys have a strategy or an underlying you want me to look at, we'll go through it step by step to see if it works. You know, for instance, I come up with, let's just say I'm looking at IBM again. I have a bullish assumption, bullish to market neutral assumption in IBM. Like I said, I think it's going to stay right around in here. And then because there's some volume going on. And then I am worried about it moving to the upside on this strategy. So if I was even more concerned about the upside, I could even dig in a little bit deeper into the money. I don't really like to do that. I like to try and stick with one that's slightly in the money and then build it out that way, get a slight credit for it. All right. And you can see on this one, when we go into the Analyze tab, let's analyze this trade and get rid of all this other stuff that's in here that's old. And you can see we barely have that slight advantage to the upside. Now, if the market comes down and pins right here, that's the only way we're going to get to our max profit of the $500, which is the width of this spread here. It's that $5 on that spread right there. That's what we'd be able to keep, and the 5-cent credit. So in this example, when we have a $5 or $500 max profit, then we are looking to get out when this strategy is worth $2.50. So we're going to be out at $2.50 or somewhere very close to it, $2.52. So that's where we're going to be looking to get out of. And that will allow us, if the market kind of trades down in and around this area and it doesn't get too far, we'll be able to get out after about 2 weeks if the market comes back down into this area for that $2.50. If the market rallies up, I'm just going to let it go. I'm just going to leave it because, you know, I don't have anything to worry about. I'm going to hope that the market comes back down here maybe during the life of that, which is the probabilities that it will finish somewhere in and around this area here at the close. On your list, most don't you have IV? Yes, this is the IV percent right here Vanu's talking about. I don't think they offer this anymore, but I have the script that goes in here and I did the customize on it. But yes, I have it listed in here high to low. Because when I'm doing strategies, if I have an assumption on something, I know that if it's up here in the 50s, then that means I'm I'm doing a premium selling strategy where I'm collecting a credit, and anything down here that I'm going to be looking to pay a debit for. And again, same thing with this. You know, you want to pay for something when it's super cheap. You don't want to pay for it when it's super expensive. And especially if we start seeing that volatility come out, you can see that we would be losing money if we bought premium in a high implied volatility environment. You can actually be directionally correct. If you bought, like, say, a call in Lululemon and you got the directional move correct, but all this volatility came out right away, you could stand to lose money despite the fact that it was moving higher. But yes, I do use implied volatility percent because it determines, it is one of the major determining factors for any strategy I do. So it is very important. And if you only have the chart, you can even eyeball it. You know, you can see that this is close to the 50 percentile when you just kind of line it up. You can eyeball it if you don't have it or if you don't want to do all the math, but the math is pretty simple to come up with the IV percent on this. It's pretty simple. Does anybody else have any other questions about this strategy? It's pretty easy. You know, like I said, you're buying one, selling two, and then you buy that for the traditional butterfly, but we sell a synthetic put spread by selling the 125s and buying the 120s. And as you can see, if I just sold the 125s and the 120s, I get 86-cent credit, all right, if I were to do that. But now we're going to buy this one, sell that one, buy that one, and you can see it's $82 debit on the traditional butterfly, but if I sell that 86-cent butterfly, I get that equivalent in the on a credit, right? So the short put spread decreased all my risk to the upside, but that short put spread, just like having a short put spread on anyway, you have risk on that downside. So initial credit needed, but we are after a bigger gain. We are after the bigger gain. We just want to make sure that we're eliminating the risk to the upside, because a butterfly is super hard to nail the number, right? You have to nail the 130 number. You can't have it go lower or go higher by $10 in the next 40 some odd days. And that's quite possible, right? So in that, I would rather eliminate one direction. And since most of the markets have had this bit of a correction here, and I believe the markets are primed to slightly crawl higher, I don't think we're going to see a major move, but I think we're going to crawl a little bit higher and then start settling down, as most of these underlyings have gone, you know, to the value area lows and are very close to the points of control, as we'll see with E-mini S&Ps, and the NASDAQ is trying to get back to its point of control. The Dow Jones is trading in and around its points of control. So yeah, we're going to get these moves, I think, back and forth from those, but I think we'll end up settling down for that. For a call and a put option, what volatility do you use? If we're talking about premium selling strategies, if we're looking at premium selling strategies, anything where you're collecting a credit, if you collect a credit, we need the IV percent to be greater than 50, all right? If we are looking at a debit, then we need it to be less than 50. And for an ETF, it's greater than 30% or less than 30% for the debit, all right? And this is for the credit. So an ETF is a little bit lower because it's a basket of goods, all right? And a lot of those will have low volatility. Some will have some high ones, but it's going to meld each other out and make it a little bit lower. On IBM, if the market is 137, could you still have the 130 as the body? Let's take a look at it. Sometimes you can. Sometimes you will be able to play around with that. And are you saying you want to short these two? So you could buy this one, short those two, skip this strike, and buy that one. Is that right? Oh, 137. If IBM's at 137, you might even be able to do this one where you buy, sell 2 of those, and then skip the strike and buy that one. I do that right? 40, 35, skip the 30. So yeah, you could do this one as well. So this one, you're definitely more bullish on this strategy. So yeah, you can usually go deeper in the money. It usually starts getting a little bit harder to go further out, but it will work if you usually work if you have the implied volatility jacked up. So 20, and I want to go to the 10. So that one doesn't work. You know, one thing you could do is if you were wanting to do this strategy, just put it at 0 and throw it in there. And if the market moves down just a little bit, you probably get hit on it. So yeah, you can play around with it. You'll usually be able to build this out with high implied volatility. But if you don't have the high implied volatility, you aren't going to have a whole lot of wiggle room. I'm not sure, Herman, what you're asking here. If it's at 137, you probably could still use the 130 strike because it would kind of be like doing this one, right? So if I did this, buying that, and skipping this, come on, mouse, work for me, skipping the strike and hitting that one. So that would be very similar to what you're talking about. I'm using the 30 here based on just rolling it down. Because if it was $5 higher, then I just went $5 lower on the strikes. Is that what you were asking? Does that make sense for that? If it was trading 137, you know, these strikes that I'm using here would be equivalent to that whole thing. What's the formula for break even? Let's go back to those. I'll throw it back up here. Actually, is it on there already? Max loss. Let's go to the break even one. You want break even? So it's the skip strike minus the credit, right? So if I pull back up the platform and we look at this example here, let's go to the example we originally used. Sell that one, sell 2 of those, and then buy this one. So our break even is when we're looking at, okay, you got so our break even, skip strike minus the credit, right? So we got this credit right here. Our skipped strike is the 25 strike, right? Because what happens here is we have set this up. We've got a long put spread, right? So a long put spread is bearish. And if the market starts moving down, well, this put spread is going to gain in value, right? So once that's worth $5, that's why we've got this room from 30 to 25 because we got this $5 on this spread paying off our risk to the 125. And then we also collected a credit for this strategy. Selling an extra, I need to build this out right. So selling an extra and buying that one. So when we're looking at the 35 to the 30, this $5 pays for our risk to the 25. And then we got this little extra kicker on the 5 cents. So it's minus the 120. So our break even would be at 119.95. All right. Because this spread right here is helping pay for some of our risk to the downside. Okay. And it's being paid for by us selling the 125, 120 put spread that's embedded or synthetically in this strategy. Right? All right. All right, without any other questions then, I guess, you know, like I said, this is a play on Vega. Make sure you have high implied volatility percent when you're going in this. And we're going to be exploiting theta, so make sure you're in the option Montage that has the best theta decay. Now, or, you know, bang for your buck. You know, the one that's 15 days to expiration is going to have a lot more theta decay. Don't get me wrong. But, you know, those premiums are going to be much less also, right? 50% less than where I'm talking about playing out in the 45 days to expiration. We want to get in a little bit early there so we get this volatility and theta contraction by selling that spread. All right, so we are coming out of earnings, right? Almost out of earnings. This is the link for the earnings webinars. And I also have one over there in the chat window. We've been going back and forth in the questions box. You can just easily click on that chat window if you like the way I teach. But for 36 bucks, you really can't beat it. And I go into the pitfalls that people on TV will talk about trading options around earnings. Stay away from what they say. Stick with what I do. I mean, I've been doing this for over 25 years, you guys. So, you know, I've pretty much nailed it down for you. But here also, if you're watching this on tape delay, you'll just have to type this into your URL, option course, earnings with options. Yes, we are very close to being out of earnings. Lulu's the one that kind of kicks off the next earnings, and we've got those coming up in the next several weeks. But another thing we have in here is with the options course for earnings is how to set up for that next earnings cycle where we can take advantage of volatility expansion during that time. So I also have the setups for going into earnings as well. That will increase your probabilities of success. But if you're trading around earnings and want to trade through those earnings, you need to really consider taking $36 and throwing it out, because you could easily lose that $36 in one simple trade, setting it up incorrectly in an earnings event. All right. Especially if you're listening to some guys from Goldman or something. Can you give us a copy of the slide notes from the thing? We can work on that, Herman. Reach out to us at trading@protraderstrategies.com and we can figure something out. And also, you can reach us at 310-598-6677. But like I said, if you want to trade earnings, this is the course to take for sure. I want to thank you guys all. Later webinars will be drilling down on different option components, trades I do when and where I find those appropriate. Also, I do talk about every single trade I do in the daily market commentaries, win, lose, or draw, and talk about the ones that I'm losing money on more often than the ones I'm making money on, because those are the ones we need to stay mechanical with. And I show you how we can turn the tables on a losing trade by being mechanical with this. So here also is that link. You'll have to type it into your URL. It's not a hot link. The hot link is over there in the chat window for you guys. Again, you can reach us at 310-598-6677 or email me at trading@protraderstrategies.com. All right. That's all I got for you guys for today, other than if you can't take that, take it easy. Appreciate you, Andrew. Thank you. Thanks, Ted. Appreciate it. Take care, Herman. Thank you guys all.